Hello, everybody, to today's low risk, high reward trading bootcamp. I'm just going to get the slide deck up. I see some people already starting to log in. Welcome, everybody. Just let me come over here and share the slides, and we'll get started right away. Righty. Got this over here. See, share screen. Welcome, everybody. Welcome, welcome. Actually, let me switch this up for a minute and start the slide share. Interesting. This little technical glitch with PowerPoint. Give me just one moment and we'll be on our way. All right, there we go. And now I just need to come over here, share the screen with everybody. Going to keep all of the microphones off while we're doing this. All right, perfect. Can everybody see the screen? And I know that I just turned the microphones off, but if you scroll your mouse around, you should see a little chat button or a Q&A bubble. Just go ahead and click those. I'll be checking in on those throughout. Michael, yes, you do see it. Awesome. So I'm going to have those open throughout the presentation. And as you have questions, just go ahead, use those. I want this to be a highly interactive presentation. The more interactive it is, the more that you will not only just receive information, but you'll be able to use the information and to be able to benefit from it and to begin implementing this stuff immediately. Like that. That's why we're here, right? So not only that, in addition to asking a lot of questions and being engaged, I want you to take a lot of notes too. So if you don't already have pen and paper, go grab some. This presentation will be recorded. You will receive the full slide deck for all of our Mara Elite members. You'll be able to access this one in the members archive along with all the other boot camps as well. And let's get right into it. So the main things that you will walk away from this presentation with today, you will learn how to dissect trades, dissect setups, and see if it really is a potential winner or not. So you're going to be able to filter through a whole bunch of stocks and see, like, is this trade actually worth my time? You're going to see the 5 major setups that we've been seeing most frequently. There's a lot more setups than just 5, but in this condensed version, I want to give you the main 5 that keep on coming up again and again and again in this market. We're going to define the best spots for entries, profit targets, and for stop losses. And by the time that we're done, we will have developed filters to trade only the best of the best setups. And basically what you're getting here, you're getting the A of this Eagle trading methodology that I've developed over the past, really over the past 10 years. I would say that this has come together. So the question then is, how do we dissect trade setups and see if it really is a potential winner? And there's two main ways to do this. The first is to take a look at the stage of the pattern. Is it a young pattern, or is it an older pattern, right? Like, where is it in its life cycle? And then going and taking a deeper dive into the pattern that we're seeing, and then beginning to dissect all the little pieces of it. So the stage of the pattern, young versus old, just like humans, trends age. And at different stages of its life cycle, trends begin to exhibit different kinds of behavior. When you see a stock that's a recent IPO and people are beginning to become aware of that stock, it'll behave a little erratically at first. Then, like, as the trend starts to mature, it starts to tighten up a bit. And then, like, towards the end of its life cycle, you'll begin to see that it starts to become a little erratic, a little wide and loose, a little squirrely. And you'll see some examples of that too. No trend lasts forever. And it's for these reasons that we really do need to learn how to identify not just the patterns themselves, but what stage is this stock in. A few simple ways. Hello? Sorry, we're just going to keep all the microphones closed during this, since we've got a lot of people joining us today. Just go ahead and use the Q&A button or the chat button, and you'll be able to ask questions, make comments, and we'll be able to go around that way. All right, so the simple way to tell stages of a trend's life would be to look for stocks that are in uptrends, and within that uptrend, so in an uptrend, we'll take a look at, well, there's many examples in this, but basically an uptrend is defined as a series of higher highs and higher lows in the price action that we're looking at. Within the uptrend, you want to look for sideways action, at least 4 weeks or more. We'll be doing a lot of work on the weekly timeframes. And then that sideways action, that's what we're going to call a base. And then you'll count up how many bases you see. So basically, I want you to start thinking of it like this, where you have these base camps, right? Where the stock is starting to consolidate over here, and then it runs up and then consolidates again. There's its second little base camp, and it's kind of like it's climbing up the mountain, and it has, there's another base, it climbs up the mountain some more, then it pauses, right? Like, you can't just charge straight up a mountain. Even like if you're an Olympic sprinter, right? Like you're not just like sprinting up the mountain. You're going to pause and take breaks as you're climbing Mount Everest. But as you get closer and closer to the top, that's when you start to, it's like nosebleed territory, right? Like, this is where everybody can see the mountain. It's obvious to the world. And as the trends continue to progress higher and higher and higher, without resetting, and the way that a trend would be reset would be like, let's say over here, you start to come back in, right? That would be a reset where you got to say stage 4 base, and rather than continuing to climb higher, it starts to come in and you're undercutting this level over here. That would be a reset, but you continue to climb higher, and as you keep on climbing higher, you're nearing the end, and eventually you will roll over. So the later you get in the stage count, the closer you are to this nosebleed territory. Everybody with me so far on this? This is a lot of the kinds of things that that we go through on the deep dives in the Trader's Mind chat room, and that we're drilling all the time. So like this is a lot deeper than what we're able to go in that a short period of time, but none of this should be unfamiliar. All right, so we're going to do some drills and count some bases, right? So for what we've seen so far, right? Take a look at this chart and let me know how many bases do you see? Actually, let me turn off my video camera. I think that my face might have been blocking some of this stuff. Carlos, you see 3. All right. Who else wants to take a stab? Michael E, 3. All right. That's the consensus so far. Okay. Bosco sees 4. All right. Let's see. So I would say to start, like as far as the bases, right? Like one of the first things that we want to look at would be like we want to have an uptrend defined first, right? So really like starting from, I'd say, like back over here, let's say. You might make the argument that, oh, well, we're starting from back here, and you might count this as a base. To me, like this, we would need to measure this, but this this is kind of shallow for it to be a base, right? Like you would just kind of moving, and let me grab the little annotation tool. Annotate. So from like right over here, you only popped out of this sideways section right over there, and then you consolidate again. So I wouldn't really count this so much as a separate base. It really, the uptrend starts more over here, and then the first base that I'm seeing after that is really more of this, where you have this defined sideways move, and this over here too, right? Like you have this. This is more of just a mess, right? Like it is sideways, but this over here where you have the yellow lines drawn, that's really the first defined base pattern. Then after that, the next one that I'm seeing is this right here. I wouldn't define, and because of some people saw the 4, maybe 5, like I'm picking apart some of these other ones that maybe it might have been what you were seeing. I wouldn't consider this over here a base. And the reason why not is because you're still having a series of higher highs and higher lows at that point. Where you have the yellow lines, that's what really the uptrend stopped, and you're getting more sideways action from that point. So I would consider those yellow lines right over here to be the second stage base. And then finally, this would be your third stage base. And even a third stage base is starting to get a little bit late in the game. let's take a look at this one, right? Let's get rid of those old chart annotations. And so take a look at this one. Now, what do you see here? How many base patterns? All right, Carlos sees 3. So far, our definitions of the base pattern, just simply the sideways action. And let's go back to what our definitions are. Right? Let's go back to the definitions. Stocks that are in uptrends. Within the uptrend, look for sideways action, 4 weeks or more, and that's going to be the general base. Pretty simple. So over here, so far I'm seeing this as a base. We have a very slight uptrend that started from back here. We bottomed back in the earlier this year, March-ish. Then again, over here. And then finally, here's another base pattern. So in this one, I would call this more of a base on base pattern, and we'll have plenty of time for like additional Q&A at the end of all this. But a base on base pattern is simply a base that forms and then breaks out and then just quickly forms another base on top of it, as opposed to forming the base and then running up. All right, and now here's another one. How many bases do you see in this one? I'd say let's start from around this area, okay, because this would be this is March, where you've bottomed. Carl sees 3, maybe 2. All right. Very good. Bosco sees 1. Who else? Come on. We've got 2 people that are actively engaged. Who else is alive? Michael E. 2. All right. So with this, and another, something else that, Jarek 2, awesome. Something else that I want to mention as well in here, and make a note, is this. When you have a bear market, and a bear market is defined as a down a correction that is at least 20% or more on the major indexes, right? So NASDAQ, S&P 500, Russell 2000, any of the major indexes, when you have a drop from the peak, right? So from, like, say up here to down here, when that exceeds 20%, then that constitutes a bear market, and that resets all of the base counts for all the stocks. So even if this base, like it didn't really undercut anything from back here, this is still would be considered like fresh, a fresh uptrend, and anything in here would still be a first stage base. So this is a first stage base, right? So that's the first base that I'm seeing. The next one that I'm seeing is this consolidation over here. Right? You have 4 weeks, then it started to pop up, and this is an interesting thing too. And we'll talk about flat bases a little later in the presentation, but this is also going to be a flat base. One of the nuances that I want to highlight here is that you see this little this week here where it poked its nose above the high of the pattern, but then ultimately closed below. When that happens, like this entry point back here still remains the entry point. Like this doesn't count as a false breakout. And that will happen frequently, where you have a short little pop above the entry point, and then it ultimately closes back below. You would still be using either the entry point from back here, or if you get an additional setup, and we'll get into really dissecting the chart patterns on not just the weekly time frame, but down on the daily time frame, and trying to find and pinpoint that advanced entry point. You might find a better consolidation within this section here. But I just wanted to point out that even though this bar happened to poke slightly above the high over here, it still counts as a consolidation. Then you have this, right? So you had the breakout over here, and then you have this pattern forming on this side over here. And notice, and I want to point this out as well, notice how this undercuts the lows of this pattern here. Does everybody see that? When that happens, that resets the entire base count. So over here, we're at, this is base number 1. This is base number 2. Because this undercut this, now this is a first stage base. The reason why the base count gets reset is because when a consolidation, like you have all these buyers and sellers in here, right? Like you have some people that are buying from back here, and they're trying to ride out this trend. And then as prices like starting to break out again, like they're getting shaken out below this support level. So that's psychologically the thing that resets the base count. So as far as stage counts go, this consolidation here would be considered a first stage consolidation. Does that make sense? Do we have any questions on any of that? Carlos, do you count the bases on the weekly? Yes. You count the bases on the weekly. You could see the bases on the daily timeframes too. And later on in the presentation, we're going to go through all different kinds of chart patterns. In fact, that's going to be the next slide. And you'll see different patterns. Sometimes you'll see a different pattern on the weekly time frame than you'll see on the daily time frame. But as far as counting up the consolidations, you want to do it on the weekly time frame. Part of the reason for that, well, there's several reasons for that. The first is it kind of goes back to something that many of you may have heard me refer on the deep dives when we're looking at the overall health of the market, and we're talking about looking at the monthly timeframes being the forest, the weekly timeframes being the trees, and then the daily timeframes being the individual leaves. And uh, it's that broader perspective that carries more weight to it. So that's why when we're looking at base patterns, we want to take that broader perspective. As far as identifying low risk, high reward opportunities, we're not really looking at monthly charts. Like that's too broad for what we're doing. Well, we're using these patterns to swing trade, where we'd be holding for a period of several weeks, several months. If you're using this kind of stuff to for longer term trading too, you absolutely can. The same kind of stuff applies if you're holding for several months or even a couple of years. The same kind of patterns would apply if you are a shorter term trader, or even a day trader. Many of these patterns, all the different types of patterns, they all repeat themselves on the lower and lower and lower time frames. It's just, it would be akin to seeing a cruise ship versus, say, a speedboat versus a guy on a jet ski, right? Like, which one is going to be able to maneuver the fastest? You're all in the ocean. You're all going to be able to travel X amount of distance, but who's going to be able to maneuver quicker? So the 5 chart patterns that we're seeing a lot of, and very recently too, and all the ones that you've been seeing really on the action lists, on the focus lists, on everything that we've been taking action on recently. We've seen so many cup with handles, inverted head and shoulders, flat bases, flags, and even short stroke patterns. And short strokes tend to be on the rarer side. Like, they occur a little bit less frequently, but we've been seeing so many of them and we continue to see so many of them, that I wanted to put them on here and share it with you, so that way you could identify it on your own, and to be able to find these kind of bases that are of higher quality. So let's take a look at a few and give you some definitions with them. This first one here, cup with handle. The cup with handle pattern, it basically looks like this, right? Like, it's called a cup with handle because it looks like a cup, like you have that U-shaped pattern, and then there's a little bit of a handle after it. All the charts that we're looking at so far, by the way, like, this is a weekly chart. I'll tell you when we're looking at a daily chart. But in order for a cup with handle to be properly structured, and there'll be times where you see a cup with handle that is only 6 weeks long. Now, like, I wouldn't toss the pattern just because it happens to be 6 weeks long and not 7 weeks long. It would just be one thing that's a strike against it. I'm of the mindset that no one thing should really be should kick something off the radar altogether. Like, there should be a minimum criteria for what we look for, and we'll get into that. But as far as the patterns go, 7 weeks is the minimum for a properly formed cup with handle. If it happens to be a little bit less then that's okay. Like I wouldn't not consider it. The approximate depth should be 35%. It could be less. It could be a little bit more, given the overall market conditions. The major indexes this year corrected roughly 40%. And So you had some pretty deep cup with handles. Some of them were 40%, 45% deep, and that's okay, so long as it is moving with the market as far as the actual structure goes. So that's the cup part. Then the handle part, this part over here, in order to be properly formed again, we want to be looking at handles that are formed in the upper half of the base. If it's not formed in the upper half, then it's, again, it's improperly formed. It wouldn't be like the right structure. The length of the handle should be anywhere between 1 to about a maximum of 3 weeks. And it really depends upon the length of the cup shape part, that U-shaped part. So for example, let's say that you have a 7-week cup with handle. You would probably just have like a 1 week or maybe a 2-week long handle. If you have, say, a 15-week cup, then you would still look for like a maximum of a 3-week handle. Like if it starts to get longer than that, then it starts to turn into its own base. But really, you're looking for the handle to be anywhere between 1 and 3 weeks long, and the depth of the handle should be approximately 12%. Carlos, what about cup with high handle? Does that pattern exist? Yeah, that pattern does exist. We've seen that too. For the and we'll be able to look at additional patterns later on as well. I've planned this presentation to be roughly 90 minutes with an additional like 30-minute Q&A at the end. If we get to the Q&A and there's no other questions related to like the patterns that we're looking at here, then we could look at cups with high handles or pennants or any of that other stuff. But the same types of things that you're going to learn in this presentation, most like you're seeing the definitions of patterns here, but how you dissect a pattern, that's going to be common to all of them, and we'll go through that in a few moments. Now, this is what it looks like on the daily time frame, right? Like it's the same kind of structure over here, right? Like where you have that U-shaped pattern. Sometimes it's easier to see the stuff on a daily time frame, right? Well, when I'm constructing my charts, I like to have multiple time frames open. Typically, I'll have the monthly time frame open, the weekly time frame, the daily time frame, and the 2-hour. I've gone to like a four window pane for my chart, so that way, like as you're drawing out this on a weekly, you could see what it looks like on the daily, and sometimes it makes it a little bit easier to see both. But the pattern itself should be identifiable on the weekly time frame. And to reiterate, part of the reason why we want to have it identifiable on the weekly is so that way you have 2 time frames working with you, right? Not just one. So if there's going to be some people like the large hedge funds, mutual funds, pensions of the world that are trading, they're going to be focused more on weekly timeframes. The reason for that is because they can't maneuver like we can, right? Like, well, we could be in and out of a position like that. It's going to take them weeks and months to build positions, and so they need to focus on the longer term timeframes. If we are lining up weekly timeframes and daily timeframes, and that's bringing more eyeballs to the table, and you want to be able to see patterns clearly develop that are valid on both timeframes. So you have that setting up over here. You have the U-shape cup. The handle is forming over here. And also look at the dry up in the volume on that handle. That's another key part of the cup with handle pattern too. You want there to be a dry up in volume in the handle. The handle should be moving sideways, or it can be drifting down. If you see handles that are kind of wedging upwards, right? Like, so when this pattern started out, well, it actually, let me grab the annotation tool again. It was looking like this and then coming down over here, right? And this actually triggered the first entry right over there. Then the pattern evolved. And we have the line that's drawn now, but you still have this sideways action to the handle. So as far as the handle goes, it's still a valid handle. Carlos, what if the depth is more than 35%? Let's say 50%. Does that cancel the pattern? I wouldn't say that it cancels the pattern, but it would be a flaw in the pattern. So let's just say that instead of being formed like that, it comes over here. And let's just say that this depth happens to be 50%, right? Would I completely pass on this? No. Well, the first criteria that I look at it, and so you guys that have been to the deep dives every Saturday, you know this part. The first thing that we look at is what? Well, first of all, we're trying to identify these kinds of chart patterns, and we go through all the stocks that we're interested in, and I go through that list very quickly to see like what pops out at me. And this is what if you want to get really good at identifying chart patterns on your own and well, what's proper, what's improper, you need to drill this. Whether you are doing this on your own, whether you're coming to the deep dives and all that, you need to be drilling this stuff because that's what's going to train your eye to pick up on it. And then when a pattern pops out at you, great. You add it to your watch list. And then from there, what's our next step? Our next step is to, number one, see what is the reward to risk of this trade. So, and we'll go through how to identify reward to risk a little bit later in the presentation, how to identify great entry points, how to identify proper profit targets and stop losses. But we want to aim for at least 3 to 1. So if this were a 50% deep cup with handle, I wouldn't let that discard it, but I would go and say, well, am I able to get at least 3 to 1 reward to risk on this trade? And if I would, then I would keep it on the watch list. If it didn't meet that minimum 3 to 1 reward to risk criteria, then it would get tossed. If it were not in a top industry group, right? Top industry group being ranked between 1 and 100 out of 197 industry groups. If it's ranked like 101, 120, then it gets tossed. The reason why, again, just like with all this stuff, we want to get as many things working in our favor as we can, because that's what puts the wind at our back. We want to be running with the wind at our back, not with the wind in our faces when we're trying to trade. That's what's going to give us higher probability of success. All right, so here's another pattern that's been popping up quite a bit lately. The inverted head and shoulders pattern. Now with this one, I would say that this needs to be 7 weeks or more. And for this, the maximum depth that I've seen for an inverted head and shoulders has been roughly in the neighborhood of 40%. It's one of the most powerful patterns that are out there. And the reason why is because you have this deeper shakeout, right? Like you have this initial consolidation right here where it looks like, oh, like it's starting to, maybe it'll bounce off of a moving average and it'll continue running. But no, like it shakes out super deep again. And then you still have all those people that bought down in here, right? That are like that, they think that they got in early, but then there's this other consolidation on this side, and people are a little skittish, right? Like they're starting to shake out some of the weak hands that are in here, some of the weak hands that maybe bought in back here that are just breathing a deep sigh of relief to finally get back to even, and then it takes off. It's one of the most powerful patterns in trading. And this one here is actually what Tesla did earlier this year, ran 200% from this level. Now, the key element of the inverted head and shoulders is that the left shoulder should be lower than the right shoulder, right? So this shoulder here, lower than that shoulder, right? So that low versus this low. Here's what it looks like on the daily time frame. And so as far as identifying the patterns, you're going to be identifying the patterns primarily on the weekly time frame. You should be able to see it on the daily time frame. And when you're looking on the daily time frame, you might even begin to see other kinds of patterns too. I know that we're only focusing on 5, and there's a lot more patterns that are identifiable. But if you're able to start to see other patterns on the lower time frames, right? Like something that I see right here is this triangle pattern setting up on Tesla. Then that's that would be like another plus to the pattern, right? Because if you're seeing it as an inverted head and shoulders, somebody else comes along and they're saying that, oh, well, I see this as a triangle setup, then it's drawing more eyeballs, it's drawing more attention to the setup, where, and because it's only a first stage base, gives it that much more potential to be able to move it and work in your favor. Questions on that? And yeah, as we go, keep on popping questions into the Q&A. And Ollie, what happens when the cup doesn't completely form, but there still appears to be a short handle? What happens when the cup does not completely form, but there's a short handle? So like that would be it would be another instance of where the pattern itself is flawed. So that's why we want to have these definitions, right, of what constitutes a well-formed pattern. But if you are trained on what is a well-formed pattern, you'll still like, as you're flipping through charts, you'll be able to see things that kind of look like they're like they've got the structure, that they have the essence of it, and then you'll be able to go and assess, well, like how good is this pattern, right? Like how many flaws do I see? Because, well, to go back to the earlier point of like flipping through the universe list, I'll flip through that thing pretty quick, and like, well, what do we like last week? How many patterns did we start off with? I think that we started off with about 23, right? I've got it right here. We started off with 23, And we filtered that down to 14. That would make the minimum cut to get onto the focus list. And then once we had our focus list, that's when, well, we started to really drill down into the nitty gritty of, like, what other things are we seeing in this? Like, does it have, is there more accumulation than distribution in this pattern? Is there more up weeks than down weeks? Is the overall shape to the setup good? Is there a volatility contraction within the base? And we'll go through all the nitty gritty kind of stuff in a few more slides, right? But it's the step one of this is right, like, well, we know how to identify the stage count and see the general consolidations. Now we're starting to see the different types of patterns, the more frequent patterns that are seeing. And not only that, we're starting to understand what is a properly formed pattern. Or like properly formed minimum criteria for the pattern. You might still see the essence of a pattern. Don't toss it because everything else about it might be fantastic, but you would be able to know what is a flaw versus what is not. Like, is this pattern still in the fight? Right? Like, if it's a boxing match, it's not knocked out. It might have a black eye. It might have a bloody nose, but it'd still be in the fight, even if it's has a little bit of a flaw. All right, so here's another pattern, the flat base. Seeing a lot of flat bases recently too. Flat base is pretty simple, pretty straightforward. It's just chopping around sideways, right? But it needs to be chopping around sideways for at least 5 weeks. It could be significantly longer than 5 weeks, but at least 5 weeks. And the depth should be roughly 15%. If it's 16%, okay, fine. If it's 17%, okay, you're pushing it a little bit. But it should be in the neighborhood of 15%. If it's less than 15%, say that it's 10%, 11%, that's perfectly fine too. It's when it starts to get into the neighborhood of 20%, like that's too deep for a flat base. Here it is on the daily time frame. You can see too, like how one of the things that we mentioned before, and we'll go in deeper, like how you see, like on this side of the base, how it's wider and looser than this side of the base. Everybody see that? Like that's some of the volatility contraction that we'd want to look for in the price action. And it's kind of like that, like a spring that's coiling and getting ready to break out. Another popular pattern is the flag, and the flag is very similar to the flat base, right? Like you have that sideways consolidation, but some of the difference with it is that you have this pole, right? And there's a flag. So there's a couple of types of flags, right? Or really 2 types of flags. There's just a normal flag where you have the pole that's could be 1 week long, could be 2 weeks long, or if you had a high tight flag, that's where it gets to be up to 8 weeks long, and you have a big run of 80 to 100%. That's just the pole. But what we've been seeing a lot more of, and why I wanted to highlight it for you, is just a standard flag where you have a big run up in the pole that tends to be at least 15%, 20%, where it's this rapid run up. Like you'll have like a big week like this. Generally, like this one happened to be after earnings. Like that tends to be the case, right? Like you tend to see these big gaps after earnings, and then you get consolidation. Yeah, that's forming the flag. So the flag itself should be roughly 5 weeks, and the depth should be in the neighborhood of 7% to 30%. And the reason why I say 7% to 30% is because for a flag, right, like it should also be constrained to no more than half the size of the pole. Like if this came down further and the flag was down here, like that wouldn't be a flag. But since it did not, like you have more of that essence of the flagpole like this way, and then this flag here with giving us the cash prize at the end, right? Yes, Jarek, flag on the play. Carlos, if the flag is pointing downwards, is that also a flag pattern? Yes, it is. So like if you had a flag that was like this, right, where you had that big down move and then you're getting price action in here, this is also a flag, but whereas this is a bullish flag, right, up here, bullish flag. This is the bearish flag. And so you wouldn't be looking for a move to break up over here, right? Like you're not looking at that. You would be looking for a move to break down this way. Does that make sense? Yeah, many of these patterns that you see as bullish patterns, right? Like all the ones that we've spoken about already, you could take the inverse of them and look at them for short setups. But and this is an important one, you want to be trading with the trend. You always want to be trading with the trend. So like what we have here, right? Like we're trending up. So you would be looking for a bullish pattern, right? And so like you're looking for there's the bull flag and it's setting up. Like if you're like over here where it looks like the pattern is starting to end, right? Like this is where you might start to be looking for setups to the downside if you're in a bearish environment. You always want to be trading with the trend, and you always want to be trading in the direction of the broader market environment as well. That's a little bit outside the scope of this presentation, but again, like for all the Mara elite members know, and everybody in the Traders Mind chat room knows that, like you've seen this week after week, where we are trading with the market environment, and well, that's part of why we want to understand, like, is the market moving up, down, or sideways, so that way we could be trading and finding patterns that are bullish, or we could be trading patterns that are bearish. right, so we had, yes. So yeah, even over here on the, it, like this looks like a flat base, right? Like I almost thought that I moved backwards on the slide, but you could see too, like how some people might take a look at this and be like, oh, like that's just a flat base. But like you do have that run up beforehand, right? So that makes it the flag on a daily time frame as well. And I would even go so far as to call this like a fractal pattern, where you have patterns within patterns. You might see it as a flag. Somebody else might see it as a flat base. Somebody else might draw an uptrend line like this and start to call this an ascending a symmetrical triangle. Finally, the short stroke. The short stroke is the shortest pattern that you'll come across. In fact, if you happen to see a short stroke pattern, but like yeah, like it's so it's funny to talk about it as like one of the most common things that are occurring, but yeah, well, like it tends to be rare. But in this environment where we've had so many stocks break out and gap up and do so on heavy volume, it's an important one to know, because like these are the patterns that have done and performed so well. Like this one here, like this was PayPal earlier in the year. I think this breakout happened in late March, early April, somewhere in that neighborhood, where it had this big breakout after earnings, and then the short stroke. Now, like why it's called the short stroke, you had that one big bar, and then a very short bar on lighter volume. The depth of the overall pattern tends to be in the neighborhood of 10 to 20%, right? Like that one big week up. And then the second week, in order for it to be valid, like this should be less than half the depth of that first bar. So if this is 20%, this bar should be 10% or less. Ideally, it should be like in the neighborhood of like a third or quarter, but at minimum 50%. And it should occur in the upper half of the range. Like this is just picture perfect, where it closed in the upper half of the range, like very tight range for that week, and that week closed below the peak of the week prior, and it too closed in the upper half of its range. All of that is extraordinarily bullish. There it is on the daily time frame, and let me get rid of that little circle. Ali, what makes it bullish? So a lot of things. The first thing, so all of these are bullish patterns. Part of what's making it bullish, and I'll point it out here on the daily time frame, is this massive volume on the way up. Right, like that's showing huge demand coming in for the stock. Whether it's happens to be this kind of pattern, any kind of pattern, when you see price moving up and a big volume accompanying it, it's a bullish sign, especially when it's happening early in the stage count. if it like if you see that happening and you're late in the count, right? Like let's say that it's a fifth stage base and you're seeing massive volume coming in and prices going to the moon, then that's a sign of euphoria, right? Like that. That's where traders are starting to say that, yeah, well, like this thing is going to a billion, right? And that tends to be where you want to sell all, if not most, of what you have, because it's too euphoric. Like there's only one, like what goes up must come down, right? Like that it apply, the laws of physics apply not only to the planet, but it applies to the market as well. This pattern that we saw here with PayPal, where it gapped up like it did right here. This and I'll give you another pattern too that you could write this down. The way to trade breakaway gaps. That's what this happened to be. A breakaway gap on daily time frame. So gap up again, huge volume, and it never undercut the low of that bar. Right? Like, so the low never got undercut. So when I see that, what I'll do is I'll set my stop loss below the low, and I will look to enter on a break above the high. So this particular short stroke pattern gave me two ways to play it. It gave me a way to play it as the short stroke, and it gave me a way to play it as the breakaway gap. More eyeballs on the pattern led to a nice big run, somewhere in the neighborhood of 40–50%. Tashan, are we seeing this forming with Snap right now, or still too early to tell? We'll take a look at Snap towards the end. I'll hold on to I'll leave this question open so we remember to come back to it. All right, let me clear the annotations and let's keep rolling. All right, so we want to drill like all those patterns you want to drill. So jot these ones down. You'll also get the PDF version of the slide deck, and you'll get the recording of these. And again, this will all be in the members dashboard as well. But these are some more samples of these 5 patterns. So go look at those later on your own time and drill them. Go through random charts, like anything that you're interested in. You're interested in Snap right now? Fantastic. Like go look at the weekly chart of Snap. Well, go back a couple of years even and try to identify these kinds of patterns. Like set up time, like book time. Here, if you really want to take your trading to the next level, book time for yourself every single day. Like if it's a half an hour, fantastic. If it's 20 minutes, amazing. Whatever amount of time that you could dedicate every single day to identifying these chart patterns, like you're going to train your eye. It's the same thing like if you were trying to play an instrument, trying to learn how to ride a bike, well, whatever it is, drilling this stuff every single day will help you get better. So block out that time on your calendar later on when we're done, and set that time for yourself every single day to go and put in this time in front of the charts. Trading, of course, is more than just charts, but if what you're trying to develop right now is your, well, what's called sensory acuity in for charts, like being more sensitive to these patterns and like what's a good pattern, what's not a good pattern, right? Like it would be like identifying like all the different types of snow, right? Like I was listening to Tony Robbins the other day, and he was talking about like how he would be with like if you were to go to Alaska and try to identify different types of snow, like they have 12 different words for snow because they are a lot more familiar with all the different types of snow, right? Like Kim from California, like snow is snow, right? For us, like what we're developing right now is our sensory acuity for like what's good, what's not good, like how many different ways can we see these patterns, how deep can we drill into these patterns, the way that you're going to make this second nature for yourself, so you'll be able to see it, spot it, and be able to profit from it right away, is to do these kind of drills. So start with these patterns, but go through any chart and you'll be able to find these same kind of patterns repeating themselves again and again and again, and you'll understand like what's flawed and what's not flawed. Now we're going to start to dissect patterns. Dissect patterns. So when we are dissecting patterns, there's really 12 things altogether that I'm looking for, in addition to, of course, the stage count. And this is just for the dissecting the actual pattern part, right? Like there's other things to consider too, as far as fundamentals go, group rank, all that stuff. But for right now, for the chart pattern, there's 12 things for the chart pattern, and it's these 12. Does it have the proper depth? Does it have the proper length? We just went through that. Does it have that prior uptrend to it of 20% or more? Maybe it's rounding out that cup with handle right after a bear market, and it doesn't have the prior uptrend, right? Like, well, that would be considered a flaw. But is that something to toss the pattern? No. If you waited for a 20% move, then you would have missed all of March, all of April. You want there to be more up weeks than down weeks within the base. You want there to be more accumulation than distribution within the base. So is there more, is the volume higher on the up weeks than it is on the down weeks? So we'll go through this. We'll go through a few different examples of this and pick them apart. 70% up weeks within the base. Additional up weeks leading up to the base. We already know what a good shape is, right? Like, well, so we discussed that already. The other ones are new so far. Volatility contraction within the base. We want it to be formed mostly above the 10-week line. Like the 10-week line is an important line in the sand for institutional investors. And so you'll often see many trends, many stocks get support on or around the 10-week line. Important line in the sand that gets defended. And the majority of your base pattern should be formed above the 10-week line. Otherwise, it would be a flaw. The overall character, tight and controlled versus wide and loose price action. And then something that we already mentioned, the fractal patterns. Is more than one pattern visible. So let's dissect some live chart patterns, and we'll do this on TradingView. So let me share screen number 2. All right, and I'll move this stuff out of the way. Does everybody see TradingView? Awesome. All right, so let's go through a couple of these. All right, so let's go through one of these blue ones. Take your pick: Adobe, BJ, PayPal, or Copart. I'll let you guys decide. Got one vote for BJ. Carlos wants to do BJ's. All right. BJ's. So BJ's was a flag. That was actually the flag that we saw earlier in the sample. So we've got the weekly chart over here. I've got a monthly chart up over here. Like it just, well, when I'm doing my actual trading, like it helps me keep the broader move in perspective, but I'm identifying the setups on the weekly time frame. And then over here is the daily time frame, and I've got the I've got a 5-minute up right there. I was zoomed in on something earlier. But when I'm assessing entry points and trying to define where I'm going to get in, get out, like I'll also have the 2-hour up as well. But as far as assessing this pattern, let's start to pick it apart, shall we? So does it have the right depth, and does it have the right length? Well, let's see. What is the depth of this pattern? Right, so the pole is 27%, right? Roughly 27%. The flag is about 14%, so about half, right? Like it doesn't have to be exact to the number, but it's pretty close. So does it have the right depth? Yes. So we would check off that box, and you should be keeping a checklist of the things that you're interested in. So well, one of the things that I like to use for this, and I've actually got it up on another screen as we're going, is this tool here. Is it essential? Can you live without this? Sure, I lived without it for a long time before I hired software developers to make it for me, but it makes life a hell of a lot easier. I call this thing the trade gauntlet, and it has everything that I'm interested in for a stock, and it's some of those things happen to be all the different elements that we spoke about already. So I'll move this out of the way, so that way you can see the chart, and we'll continue to move along. Is it the right length? So the flag portion, 1, 2, 3, 4, 5, and then it finally started to break out over here on week 6. So yeah, it's about the right length. So if we're going along and we're checking off different boxes on our checklist, it's got those. Does it have the prior uptrend of 20%? Well, let's measure. Right, like so from here to there. Right, well, it's had about a 40% move almost before breaking out. So we can check off that box. Then does it have more up weeks than down weeks in the base? And well, why is that even important? Right, like the reason why it's important is because it's showing bullishness in it. Like if it's closing up, that's bullish. If it's closing down, then it's bearish. But like it's not where you would say that, oh well, like it's where you would toss an idea because there's a little bit of bearishness in it. Like there's always going to be buying and selling in it. Our job is to figure out like who has the leg up, the bulls or the bears. Like it's never going to be like just like a one-sided battle, or very rarely where you would see like everything lining up, kind of like what we did it in PayPal. Most of the time, you're going to have this this boxing match back and forth. So over here for the pattern, we've got 1 week up, then we've got 1, 2, 3, 4 weeks down. We've got, so 1, 2, 3 weeks up, 1, 2, 3, 4 weeks down. So there is more down weeks than up weeks in the base. So cannot check that. That would be like one flaw, right? It's not perfect. Does it have more accumulation than distribution in the base? Now, well, what does accumulation and distribution? Well, what is that? How can we tell what it is? Well, an accumulation week is an up week where prices closing near in the upper half of the range or near its highs on heavier volume than the week before. So you look at this, and volume was heavier than the week before and price closed up. So this counts as an accumulation week. If price closed down here, it would be a distribution week. So the first thing to look for, accumulation, distribution, take a look at the volume. Take a look at the weekly volume and take a look at the week right before it. Is volume higher than the week before it? Yes, great. Now we need to ask the question, where did it close? And where it closes, that's what determines, is it accumulation or distribution? So here we've got accumulation, and volume here is lower, volume there is lower, lower, lower. We've got a finally up week of volume, and this counted as a distribution week, right? Because look at the price action. It closed near the bottom of its range. It attempted to go back to fresh highs, and price was rejected. So that counts as a distribution week. So we've got one accumulation week, one distribution week. So we're not checking off that box. 70% up weeks within the base, right? Just to go back to our checklist. Clearly not, right? Like if this box isn't being checked, then that box basically is never being checked. But we also want to see, like, well, what was life like before the base, right? Like if you see a very strong run up to the base, then that's something else that could be very bullish, where like you start to see like some selling within the base before it takes off. But like, let's say all of this was up week, up week, up week, up week, then that's something that you want to be aware of as a very bullish sign, where you have so many up weeks in a row. You don't have that here. And you have about half the weeks being up and half them being down. So you're not checking off that. Does it have a good shape to the setup? Yes, it does. Well, it fits the definition of what we mentioned earlier. Is there volatility contraction within the base? Well, this is where also looking at the daily time frame becomes helpful. Right, so you come over here and you can see like how the price action over here, like just look at the bars, right? Like how these daily price bars, like how they're wider and looser, and then they're starting to tighten up, like the bars are like the bars themselves, not just like this coming down to here, and then this coming down to here, and then this coming down to here. Like that's volatility contracting as well, but also like the bars themselves are getting tighter and tighter. That is volatility contracting. And when you see that within any kind of base, whether it's a flag, a cup with handle, or whatever, that is a positive sign. It's something that you want to see for a bullish pattern. So we can check those boxes off. Is it formed mostly above the 10-week line? Yes, the whole thing is formed above the 10-week line. Are we seeing tight and controlled price action within the base? Yes, we are. Tight and controlled is very similar to the volatility contracting. The main difference between tight and controlled price action and volatility contracting would be like if you saw volatility contracting and then like it started to widen up, right? Like, or you might see like, let's say over here, and like I'll get rid of that. Let's say you still saw these bars on this side still being about the same length as they were over here. Like you might see tight weekly closes and that still counts as tight action, but volatility is not contracting. Does that, let me know if that makes sense. All right. And then, oh, are you seeing fractal patterns? Well, like with this, you might even see that a baby volatility contraction pattern where volatility is continuing to contract along the way. It's not one that we mentioned as one of the main 5 that we're focusing on right here, but another type of pattern is the volatility contraction pattern where you have volatility continuing to contract and then breaking out. So yeah, that counts as a fractal pattern. So overall for here, right, like you're going through, you're checking your boxes, and the stronger your setups are, the more you're putting in your favor for the pattern to work. And that's what we want to be looking through on every trade that we're going to entertain. Sounds like a lot of work, right? You know, while like it is a lot of work, and that's part of why you know, like most traders don't win at this game, because most of them are not willing to put in this level of work, this level of detail. And but when you do and you develop that sensory acuity, you'll be able to see like, well, what's a good pattern, what's not a good pattern. Have checklists, have tools to help guide you, and to check yourself to make sure that you're seeing these things. Let's go back to the presentation. Number 5. All right, so we dissected the live chart in TradingView. Keep on using the chat in the Q&A box if you have questions. Let's talk about indicators. There are a handful of indicators that that I look at. A lot of people go nuts with indicators. Like you've already seen, like all the charts that you've seen, like that's it as far as what I'm looking at. There's a handful of moving averages, and the reason why moving averages are useful, why I like them, is because they show momentum. Right? Like if price is above X, Y, and Z moving average, then that's showing momentum. And it also serves as a great time-bound stop, right? Because like if price is moving up and then all of a sudden like it starts to consolidate, those shorter term moving averages will catch up to price. And then if it continues to move sideways for too long, you don't really want to stick around in something that is just moving sideways. So yeah, like uh, that's a big part of what moving averages will do. The ones that I'm most interested in are the ones highlighted here, the 5, the 10, the 21 EMAs, 50 SMA. The reason why 50 SMA and 200 SMA, those are the industry standard ones. And so because it's industry standard, we want to be aware of them as well. And same deal with the 10-week SMA and the 40-week SMA. They're very similar to the 50 and the 200 just on the weekly time frame versus the daily. The trend lines, we already saw a bunch of trend lines already. That the trend lines could be both horizontal as well as diagonal. Trend lines are important because they show price structure. They're useful for entry points. They're useful for stop losses, and they're useful as backstops. What's a backstop? A backstop is what I call when prices moving higher and you raise your stop. I call that a backstop, and I'll give you some examples of them when we get back to some of the live charts. I look at simple price and volume as an indicator as well. The price and volume is that by itself tells you so much. Like it tells you a story. If anybody in this room has ever read William O'Neill, How to Make Money in Stocks, like well, what this guy would do, like just based off of price and volume, like he would write notes by hand, and the entire sheet of paper would be, the whole chart would be filled with notes just based off of price and volume. You don't need to go nuts with all these other indicators or candles or any of that other stuff. Just high, low, and close. It tells you so much. And it also helps you define major areas of support and resistance. The relative strength line versus the S&P 500. It shows you if the stock is a leader or a laggard. And finally, the last thing that I consider is the Fibonacci extensions and the retracements. And I find them useful for confirming price targets as well as support levels. Question from Ali. If we have time at the end, well, we could touch on position sizing, but it's outside the scope of this boot camp. But if we don't get to it, if we don't have time at the end, definitely like ask whatever questions that you have inside the Trader's Mind chat room, and we'll be able to go in deeper in that in the room. So entries, part of the idea for finding great entry points, and this is really true for all of the entry points, the stop losses, as well as the profit targets. What we want to do is stack as much stuff in our favor as possible, but within the framework that we've already defined, right? Like, so we, on the prior slide, we like, this is what we're looking at, right? Like, we're not throwing in, say, stochastics or MACDs or anything else that you want to come up with. It's these are the indicators, and then stacking as many of those in our favor as we can. So for the entries, well, what's important, it's looking at daily price structure, weekly price structure, trend lines, and Fibonacci retracement levels. For stop losses, we'll be looking at the different moving averages. We'll be looking at Fibonacci retracement levels. We'll be looking at trend lines, daily price structure, and weekly price structure. All of those things, like the more that you could stack up for any of these things, like I often say that for the support levels that I want to look at, like ideally you want to be able to drive a bus over this support level and for it to hold, right? And then for when support doesn't hold, then it's telling you that something actually is wrong with the pattern, or something is flawed, or something the pattern or the trends are changing, right? Like that's what we want support to be. So like if you do get stopped out like that's a good thing, right? Like there's so many times where like if you get stopped out, like it's you're exiting before price falls apart if you're setting it at the right spots. And then for targets, stacking the odds in our favor, we want to aim for profit levels that are 20 to 25% above the pivot on any of the patterns that we've looked at already. We want to have Fibonacci extension levels. We want to look at psychological price levels, major round numbers, right? Like fives and zeros tend to be psychological numbers, like price hitting $50 a share, or price hitting $100 a share, things like that, 25. 75. And then also measured moves. A measured move is a move that will be equal to the depth of the consolidation. All things that we're considering when we're setting profit targets. And the more boxes that we're checking, the better. So let's take a look then at some targets and finding entries and stop losses and all that great stuff on TradingView. So we'll come back over screen number 2. All right, so everybody see TradingView again? Yes, no, maybe so? Awesome. All right, so first spot that we would be looking at on here, and let's replay it from back here, right? So you see price starting to consolidate, and well, let's get rid of this, get rid of that, get rid of that. All right, so now we zoom out, and we still got the, that's okay, that we've still got it over here. But well, so back here, like this is where I would be starting to draw this pattern, and you would see the setup. You see that price is in an uptrend. It's forming this flag pattern, and when you're identifying or trying to find the way in, I always like to look for, well, where am I going to get in? Where am I going to get out? And what's my target going to be? So I see this setup, this flag setup, and then I would come down to the daily time frame and start to enter my potential entry and stop loss, right? So I would want my stop to be somewhere in this neighborhood initially, right? Like that's where price came down to so far. If we break out over here without retracing below the stop first, then that means that this price level should hold. On that day, it's no coincidence that it came down to prior resistance, right? So floors can become ceilings, and ceilings can become floors. That happened right here, right? Like where price broke out, this level over here around 35 and change was acting as a floor. Then it fell below the floor. Then it started acting as a ceiling. Then it broke out. Now it's acting as a floor. So if we break out over here, this floor then should hold. So I will be looking at that. And the first thing, since we're this is a standard pattern, I would be looking for a move of 20 to 25% to give me at least 3-to-1 reward to risk. and it does. Like if I'm hitting in the neighborhood of that range 20 to 25%, I'm getting 3-to-1 reward to risk. So it's good enough to play at this point. So how do we assess the stop loss? Right? Like how do we assess all this stuff? Well, we go back to our checklist, right? And I'll move this over onto the other screen so that way it's not blocking your guys' view of the chart. But we'll go through all of it together. Right? Like it's like I've been doing like analyzing stocks this way for a number of years now, and like even I like still have the checklist to make sure that I'm hitting every single thing. So does it have the 20% above for the target? Yep. Let's look at the Fibonacci extensions. Right? Does it have that as well? Can we see if there is this a, how many things is it lining up with? Well, it is sort of close to the 2618 level right there. Let's see what happens if we move up it up. See if we go beyond, if we're at 25%, then we're right at that 2618, right? And if I'm actually going to trade this stock, like let's say like this is really on the radar, I'm very interested in it, then that's when I would click into here and get the exact entry point, the exact stop loss, the exact target, all that stuff to see like how close is it. If it's within a couple of cents of the 2618, I would check the box, right? If it's like $1 or $2 off, then I wouldn't. For this one, in this case, I would do it, and I would enter like so right here. Price that high is 37.96. If price is 37.96, then I would look to take a breakout that's 38.05, right? Like that happened to be 38.10. That's okay. I would probably go a hair lower. And on this, 38, 35, 45 is the low. I would put it at 35.40. Just a hair below. So is this at a psychological price level? Not quite. Like it would be great if it were at 50. In fact, we could set the target at 50, but there would be less layers of confluence for the target if we did that. Then for the measured move, there's really two ways to do it for this one, right? Like you could take the length of the pole and see where that lands us on it. That's pretty damn close, isn't it? For that, I would be checking that box too. So we have 3 layers of confluence, right? You're only going to have one Fibonacci extension level, right? It's never going to be more than one Fibonacci extension level. So we've got the Fib 2618. We've got 20 to 25%. Check that box. And we've got the measured move. It's a great target. Next, let's pick apart the support. So what layers of support do we have for this? Well, we've got our stop loss is at 35.40. So if price were to break out, that means that for right now, like let's say it breaks out the next day, it would need to go back through the 5 EMA and the 10 EMA. So we would check off those boxes. It wouldn't have to go through the 21 EMA yet, so we can't check that off. We're not really checking off any of the other moving averages. So not as good as it could be. But that's okay. Well, when you have, it's not a deterrent. Everything we never want to look at anything in a vacuum. We always want to take everything in context and never get caught up in the minutia. So we'd want to zoom out, take a look at the weekly time frame, and we started drawing all this stuff back here, and 35.40 is our stop. So we're below both the weekly price structure, right? Like, because we would be making a new weekly low if we broke out. Or if the price broke down, rather. And we are at daily price structure. So we get to check both of those. When it comes to drawing trend lines, you want to be very careful, right? Like trend lines, like diagonal trend lines are fuzzy. Fuzzy in that you want to have multiple touches, like 3 minimum, right? Like if it's less than 3, like it's not a valid trend line, not a valid diagonal trend line. You could use them to identify structure, but as far as support goes, it must have at least 3 touches. And this for the Fibonacci retracement, there's also the 0.5 fib level. So for support, we've got all these boxes checked. And then let's assess the entry point. So the entry on this, we'd be getting above both daily and weekly structure on that bar. All right, is that clear? There's no trend line. There's no Fibonacci retracement level, right? Like the 1 doesn't count as a retracement level. Like that's just where it's starting. And so overall for this, right, like for this section, right, like to go back to the eagle, right, like the A part of what an eagle stock is, it's so far like, oh, and we would gut feel I would put this at a 5. It has a score of 0.94 out of 2, right? Like it's not terrible, but yeah, like it did not check as many boxes, right? Like there were all these that it missed. The support, the level was not as strong, right? Like it ideally would be looking for more support levels within it. And yeah, like the entry could be a little bit better, but one of the most important things I would say is the support. And again, it's taking everything in context and not getting too caught up on the minutia, which is why when you build your own, like if you had your own checklist, right? Like if you're an elite member, like you should be using this. this has values on all the different criteria to go through and check, and you wouldn't be assessing like you would be looking at the overall score, right? Like there's all these other criteria to go through for what's for a leader, for like how is it fundamentally, right? Like how is the growth, like is this a game changer or not? Taking in all those things into account. But just as far as the setups go, right, to pick apart the setup, yeah, like this one has about half of what we're looking for with that kind of a score. Still ended up being a good idea. Still one that I personally traded and traded for a while. Right, we got the breakout, and it didn't really shake us out for like, yeah, like it got right to the that 25% target. So all right, we've got about 15 minutes left. I want to open this up for any questions that you guys have. Let me throw the camera back on. Let me know what questions you have, what you thought about any of this. Questions related ideally to the what we've been going through, right? Like if we wanted to do position sizing, if there's no other questions, like okay, fine, we could do that. But questions first on anything that we've gone through throughout this boot camp. Ali, what's a rule of thumb for adding to a position? So for me, what I would do, like I would add to a position as more consolidations are occurring. So for example, like with JD, right? Like JD, I got in, my initial position started down here, right? Like there was a like I would call this an early entry in what was a cup-shaped base, right? Like it was forming the cup and it was rounding it out, and then it started to break out right over here. So I'm getting in right there. Then it added the handle, and I'm getting in again on, I believe it was this day here, where I added to the position. It was one of these days in here. And so the reason why I added to it wasn't because it just set up again and I could throw some more money at this thing. It was because it had already hit my first profit target. The way that I take profits too, and I should mention that this as well, is via multiples of what I've risked. So in this case, like down here, if I'm entering there, my stop loss is somewhere in this neighborhood, and my profit target, and we're going based off of here, right? Because that is the cup. So actually, let's move this up to over here and say, what's 20%? Somewhere around 100, right? So I'm targeting 100. My stop loss is down here. So I've got a 5-to-1 reward to risk. I make 5.4%. I've made 1 times my risk, and I'm selling a portion into strength. But then it sets up again. And because it's set up again, and where support happens to be, I can add to my position without adding additional risk on top of the position, because now my stop loss is going to be over here, right? So it's basically almost doubling my position size, well, with keeping the risk the same as it originally was. So on just simple round numbers, right? Like let's say we've got $100,000 account. We're risking $1,000 on this first position, right? Between entry and stop loss. Price moves up, made $1,000. Great. Take a portion off. Comes back in, sets up again. I'm still only risking $1,000, but now my position size is twice as large as it was before. And the reason why the risk is still only 1,000 is because now my stop loss is break even on the original position, but is down here on the new position. Question from Carlos. Mike, could you please expand more on backstops? Are they the same as a stop loss? So let's go through, say, Adobe. All right, so on Adobe, we had this, right? Like we had this move, it broke out, and then over here, like we had this little consolidation, broke out, and it had this level right here, right? Like that started to, that would be a place to set a backstop because you have a price consolidation, it breaks out again. And so if price starts to fall back in and retrace, then that is a sign that, you know, it's, the trend is changing. So when you have a price consolidation, you raise a stop up to below that level, that's the backstop. So it's still a stop loss. As far as I'm aware, there's no broker that says backstops. That's a term that I use, versus like just like raising your stop. So like if your stop loss started down here, you would raise your stop. When you raise your stop, that's a stop loss. No problem. Let's answer Tashan's question about Snap. Would you consider Snap the beginning of a short stroke setup? Let's zoom out to the weekly and see. So if it did not break out already, it would. But I think it would depend really on how it closes the week, right? Like, so you have this long week here, you have this week here. Like, I think that like if it closes, let me change the color of this, right? Like, so let's say that price closed up here, not a short stroke because it had already broken out. If it closes where it is right now for the week, then it is a short stroke, but it would be flawed because this price bar is not contained within the price bar immediately before it. But it does have the depth so far. It does have the lower volume so far, but there might be other setups in it too. Very strong move, especially the way that the market's pulled back the past couple of weeks, especially today. Yeah, Tashawn, my pleasure. What else we got? Other questions, comments? Ollie, what's a con to adding as the stock price goes up? Well, I would say that, what's a con as like if you're adding at an improper place as price moves up, or if you end up being overly exposed in one stock, then your equity, like you might see greater swings in your equity because you have more capital tied into one stock. So if you are going to pyramid it in, and like this is a form of pyramiding in where like the stock sets up, it breaks out, it gives you another setup to add on to. Like you want well, like the way that I trade is to continue to feed my winners if they're offering additional setups. If I were in Snapchat right now, like let's say I got in somewhere in this neighborhood when it was starting to break out down here, and I was in this, then I would probably use that breakaway gap to add to the position, and look for other spots. For right now, this is not one that I'm in on a swing, but it's one that we've been highlighting for day trades, right? Like just because a stock moves out and is away from us doesn't mean that it's not tradable to anybody. You could still find these same kind of price consolidations that we've spoken about on the intraday timeframes. Whoops, didn't want to draw that. But yeah, like if you're going through like say a 2-hour chart, or even like say a 5-minute chart, like if you happen to day trade as well, you could look take the same principles, look for the same kinds of patterns, and trade them on an intraday basis. If you don't want to day trade, you don't have to, right? Like it's what I would suggest doing is identifying the like figuring out what your goals are. Once you've identified what your goals are, that not just financially, but how you want to structure your trading around your life, what you have time for stylistically, like what resonates with you, then you could start to reverse engineer, well, how do I want to achieve X, Y, and Z goals? Swing trading for me has been a great way to do that. Like I started doing this back when I had a day job, and the reason why I was able to swing trade back then is because you don't need to pay attention to the market in the middle of the day. Most of what I'm doing is done at night on weekends, even now that I'm doing this stuff full time. It frees up most of my day to continue to educate, to coach with things that I'm passionate about doing, and leaves time open for family too. 4 to 5 digit returns and being able to come in and out to just check up on my position, sticking to the plan. So 4 to 5 digit returns. So you're looking for 1,000 to 10,000% returns. Am I hearing that right? So if we're starting out, right, like I think that's a great aspirational goal. I would say that like if we're trying to climb let's say that our ultimate goal is to climb Mount Everest, right? Like, but we've never climbed the mountain before. Then we should first start with a smaller mountain, maybe learn about like what kind of gear we need to climb the mountain, get some other things in shape, and make like, okay, we've got the big goal, right? Like we want to have the 10,000% returns. We want to have 1,000% returns. That amazing goal. How do we begin to deconstruct? How do we get to that? Well, the way part of the way that you're going to get to that is through boot camps like this, and focusing on the other 8 core skills of trading. There's 8 core skills to trading mastery, right? Understanding setups and trade analysis, that's just one of them, all right? The other 8, and we went through them on the the other boot camp that we did, right? I've got the sheet right here too for Mara 66-day challenge, where you would go and focus on one core skill and developing it for 66 days. That's how you're going to start to make this stuff habit. Setups, position sizing. You need to master trade management, portfolio management, back testing, journaling, reviewing, and mindset. All those things, those 8 core skills, are needed by every trader, especially if you want to be world class, where you're able to generate 1,000%, 10,000% returns. It's totally doable, right? Like we live in a world where we are going to Mars, right? Like we're visiting other planets. Like we're able to do that. You're able to generate 10,000% returns. It's a matter of what does it take to actually do it, and deconstructing what it takes. Develop the core skills. Once you have the core skills down and you're focused on that, then you'll be able to generate those kind of returns. But the focus needs to be on skill development, not on achieving the return and like, oh, like, am I going to achieve the return in a year? Maybe, right? But not if that's your primary focus, because then you've got one eye on the goal and one eye on the skill. Keep both eyes on the skills and you'll be able to get there that much faster. Other questions? All right. It is now 6 o'clock. I want to say thank you all so much for, oh yeah, Ali, you've got one more question? I'll take one more question. Yes, no, maybe? All right. So you'll be yeah, O'Neill's book is fantastic. Minervini's books are fantastic. I would go back, and if you haven't read Stan Weinstein, also amazing. Well, what's the title of his book? Profiting in bull and bear markets. Actually, I've got it on the website. If you go to Trading Books to Read, let me share the screen again. Share screen number 2. Yeah, for chart patterns, Stan Weinstein's Secret to Profiting in Bull and Bear Markets. This is excellent. O'Neill is excellent. All the Minervini books are excellent. Yeah, go back, read those guys. There's a lot of great books on here. I actually need to update this. There's others that I would recommend as well. As far as chapters from O'Neill, go read the first 100 pages. That's where all of the annotated charts are, and see how he did it. There's a lot of different ways to trade. There's a lot of different styles. One of the things, and I'll leave it with this too, the thing that's something that specifically helped me from O'Neill was when I finally learned, and this, like, it's from O'Neill, but it's also not from O'Neill. One of the things that O'Neill mentions in How to Make Money in Stocks is that it's not his system, it's the market's system. Now, what does that mean? Does that mean that, like, oh, like he's found the Holy Grail? No, like he's found a way to allow the market to speak to him, right? So we can model his success, but we also need to allow the market to speak to us. So I'm going to see the market a little bit different than you are, and you're going to see the market a little bit different than so Ali, you're going to see it in your own way, which will be a little bit different than Tashan's way. That'll be a little different from Michael's way. That'll be a little different from Carlos's and everybody else that's here with us too. We could all use the same methodology, but we're all going to see it in our own unique ways. And that was something that I learned Not as much from reading O'Neill's book, but more so when I became an IBD Investors Business Daily meetup leader, and I met other people that were following his work, and I started to see that, oh, well, this guy's a hedge fund manager, that guy's a full-time trader, this other guy is doing his thing, and they're all looking at it, this stuff in their own unique ways. And then that's when it dawned on me, like, all right, like I need to, like, I could use this framework, but I need to do it my way. And that's when things started to change for me, and things started to take off. And then as I've gone further and further in my education, and the education never stops. Like, I'm still learning more every day. And like, if you spoke to me in another 10, 20 years, I'd still be in the learning process. That never stops. But we continue to learn, we continue to grow, we continue to evolve and get better. So learn from others as much as you can, and also like adopt mindsets, and learn to you'll learn to develop that sensory acuity, right? Seeing the nuances of not just patterns, but also not just chart patterns, but also patterns of thought. And yeah, you'll be able to see things a lot clearer as you continue to gain more experience. And if you are approaching the market as a student, as like you're there to learn from the price action, learn from like your own actions in the market versus trying to make money and trying to make money now, then if making money now is the goal, like you're going to miss the lessons, and the lessons are far more valuable. If you're actively being a student and you're there to learn, and you're learning based off of your own actions, and yes, you're making money as you go, but your focus is on developing skills and learning, you'll develop a lot faster, and you'll be able to hit your profit targets and achieve that 1,000%, 10,000% return that much faster. All right, everybody. I hope that was valuable for you. Thanks so much for being here. I'd love to hear your feedback. So please email me later on. I will send out the recording of this session. Zoom just takes about an hour or so to render it. So I'll send it out as soon as it's done. For all of the Mara Elite members, you'll be able to find this in the members dashboard. Yeah, just for the sake of the members that are new, you just click the members area, you log in, and you would go to the boot camps archive, and it'll be the first one, and you'll be able to see all the other boot camps and deep dives and all that other stuff that's in there as well. All right, everybody. Thanks again. Truly appreciate it. And I will talk to you all soon. Take care. Much love. Peace out.